Today I'm going to go over some of my favorite income investments that I rely on for high dividend distributions. As I mentioned last week, when it comes to investing for dividends, there's two different methods that we need to define. The first type is known as dividend growth investing. This involves investing in stocks, ETFs, and other funds that offer lower dividend yields but offer consistent share price growth and dividend increases over time. The second type of dividend investing is referred to as income investing. This strategy involves investing in stocks, ETFs, and other securities that offer much higher yields but typically little to no growth in share price or distributions over time. For these investors, most of the growth they'll experience will be by reinvesting their dividend distributions back into buying more shares of their holdings. For this video, we're going to be looking exclusively at income holdings. These are the investments that I own that I rely on for high distributions, and I don't expect hardly any share price growth or dividend increases over time. If you are interested in knowing what my current favorite high-yield dividend growth stocks are, I'll leave a link to last week's video in the description. So with that being said, let's go ahead and get started. Starting off, let's take a look at some business development companies. These organizations invest in privately owned, small and medium-sized businesses that typically don't have the same access to more traditional funding options that other businesses do. It could be they're not big enough to go public, or they might have some other unique situations going on that a bank wouldn't be able to fully assist with. These kinds of stocks are ideal for income investors because they typically offer yields anywhere between 8 and 10% on average. It's because they're required to pay out 90% of their earnings to shareholders in the form of dividends. And because most BDCs hold floating rate loans in the companies they invest in, this means that during periods of high interest rates like right now, many of these stocks are actually increasing their dividend distributions. Although for years before interest rates were so high, many of these BDCs went years without increasing their dividends. But BDCs continue to be an excellent choice for income investors. I personally hold a lot of BDCs in my portfolio, and I'll go ahead and go over some of my favorite ones that I rely on for income. I mentioned last week that Ares Capital is my favorite BDC, and it's actually been a better grower than most BDCs, which is why it's not going to be on this list. But my second favorite business development company that hasn't offered as much growth yet is Owl Rock Capital Corporation, ticker ORCC. They provide direct lending solutions to U.S. middle market companies and hold mostly senior secured loans. This company is still pretty new, having their IPO less than 4 years ago, so they don't have a well-established track record yet compared to Ares Capital or Main Street Capital. But despite being new, there's already a lot of good things about Owl Rock Capital that I really like. They're the third largest BDC in the industry with a portfolio size of almost $13 billion. 87% of their loans are senior secured and 98% of them are floating rate, which explains why Owl Rock was able to not only grow their dividend for the first time this year, but they've also been increasing their special dividends. Only 2 out of their 180 investments were having a difficult time paying Owl Rock, which is much better than what I've typically seen. Finally, one more good thing is that they have 4 investment grade ratings, which is just another positive for any BDC to have. Although it's too soon to tell if Owl Rock might actually become more of a dividend grower than an income stock, so far this company's been a really good performer, and hopefully you can see why I'm a big fan of it. Another BDC that I like is Sixth Street Specialty Lending, which is ticker symbol TSLX. They're also a company that provides senior secured loans and other investments in small and medium-sized businesses. They're a much smaller BDC compared to Owl Rock, as they only have a portfolio size of about $2.9 billion compared to ORCC's $12.8 billion. But despite that, they've also been a really good performer, and until the chaos started in 2022, they actually had a good history of growth. You can see their share price has had an above average amount of growth for this kind of company. Additionally, they've been able to grow their dividends a few times in their history, although it's been less consistent. Just like with a lot of BDCs, TSLX has been issuing more dividends during this period of high interest rates. One more BDC that can definitely be considered an income holding is Pennant Park Floating Rate Capital, ticker PFLT. Over the long term, you can see their stock's share price is basically flatlined, but on the good side, they've never reduced their dividend, which it does pay monthly, by the way. But although they just recently increased their dividend, I have been slightly disappointed with this company. They have been dependable throughout the years, which is great, but given their portfolio holds 100% floating rate loans, this company should have seen even more growth than what they've already reported, in my opinion. Since they're collecting higher interest payments from their borrowers, I think we should have seen even more increases in their dividend. But ultimately, PFLT is a decent stock and it's done fine for more than a decade. But moving on, when it comes to income holdings, one of the best types of investments would have to be closed-end funds. CEFs are kind of like a weird mixture between ETFs and open-end mutual funds, like what you'd find in your 401k. I've shown this graph a few times from Hoya Capital to really highlight what exactly the main differences are. One of the biggest differences is that nearly all CEFs are actively managed investments. You have fund managers who are hand-selecting everything that goes into them, sometimes even making changes on a daily basis. Oftentimes they'll also use leverage, which can make them riskier holdings on average. But there's a lot of closed-end funds out there that offer massive dividend payments, and the majority of them do pay monthly. It's pretty rare for these investments to offer any huge long-term growth, but those huge dividends make them ideal for income investors. There's a lot of companies out there that offer closed-end funds, but my favorites would have to be from PIMCO. This company has a number of closed-end funds that have provided solid monthly dividends for years, even decades on a handful of them. In my opinion, they're probably one of the most well-managed closed-end fund providers out there. Some of my favorites by PIMCO would have to be PDI, or the PIMCO Dynamic Income Fund, PTY, which is the Corporate and Income Opportunity Fund, and PCM, which is simply known as the PCM Fund. Although I think their share prices are going to continue to struggle until interest rates stop increasing, both PTY and PCM have been able to deliver solid monthly dividends for decades. The amount they pay in dividends tends to fluctuate over periods of time, so for example with PTY there's been years where it's paid 12 cents per share per month, then a few years later they increased it to 13 cents per month, and then a couple years later after that they brought it back down to 12 cents a share. And although it's rare, some of them do pay out special dividends once a year, but it's not every year they do this. There's other closed-end funds I like, but I'm personally a big fan of PIMCO, and these are just some of my favorites by them. Let's turn our attention now to some mortgage REITs. These are companies that invest in real estate securities like mortgage-backed securities, mortgage servicing rights, and other types of non-physical real estate assets. These companies typically offer yields anywhere between 8 and 10% on average, which is about the same as business development companies. So I'll just give a couple names that I do like in this industry. The first one is Ares Commercial Real Estate Corporation, ticker ACRE. You can probably guess, but one reason why I do like this company is because it's managed by the same company that manages my favorite BDC. They're one of the few companies in this sector that have never cut their dividend throughout their entire history, and more recently they've been paying special dividends. One concern I do have for them though is that they do invest a lot in office mortgages, which is a sector that tends to struggle a lot during recessions. Now I haven't seen anything to indicate this company's struggling. In fact, they just announced their earnings 2 weeks ago and they did post some really good numbers, but it's something that I constantly keep in my mind for this company. Another MREIT that I've been much more impressed with recently is Rhythm Capital, ticker RITM. They're a mortgage REIT that's completely revamped itself compared to what it was back in 2020. Formerly known as New Residential, after the pandemic, this company decided to go in a new direction, which included focusing less on mortgage-backed securities and more on mortgage servicing rights. They've also been branching out into new areas, which include investing in other real estate companies and internalizing their management. The only thing I don't like, and I think everybody else seems to be on the same page here, is their terrible new company name. But RITM and ACRE are currently my favorite mortgage REITs, and although I do hold very small investments in other MREITs, these two are my favorite in this field as of right now. Finally, let's take a look at some covered call funds, which in my opinion you could describe as income holdings, or you could even branch them out as being their own investing strategy altogether. These funds write call options on indexes, which depending on the market can result in some huge dividend distributions. The covered call funds by Global X, which include QYLD, RYLD, and XYLD, are all positions that I hold. All three of these funds pay monthly dividends, and they average around 13% in terms of dividend yields. These types of funds have become so popular that Global X is now offering other types of covered call funds, which aim to offer more share price growth, as well as some that target specific industries. Other companies have also started offering their own covered call funds. I'm also a shareholder of JEPI, which is another fund that uses covered calls. This fund offers a lower yield than Global X's funds, but it offers more share price growth. I've known people who only invest in these covered call funds, and there's entire online communities for these people. But this isn't something that I'd personally recommend doing exclusively. I think all dividend and income investors should at least hold one dividend growth ETF like SCHD to help diversify your portfolios. I'd recommend that all high-yield investors keep a wide range of different investments in their portfolio, including REITs, BDCs, closed-end funds, and so forth. And that's going to wrap up our look at some of my favorite high-yielding income stocks. There's more out there that I own, but I wanted to highlight these as just my favorites for this video. Remember to always perform your own research and come to your own conclusion before making any investment decision. With that being said, thank you all so much for watching today's video, and until next time, take care.